The date is August 14th, 2024. The Consumer Financial Protection Bureau releases a data set that should have stopped every heart in the financial sector. $12 billion. $12 billion in penalty fees alone. But this isn't just a story about being late on a payment. This is an autopsy of a systemic psychological harvest. To understand how a 5-gram piece of plastic became the most efficient wealth extraction tool in human history, we have to ignore the marketing. We have to look at the infrastructure of the swipe. Most people believe a credit card is a tool for convenience or a bridge for liquidity. They are wrong. In the high-stakes boardroom of a top-tier issuer, your credit card is not a product. You are the product. And your loyalty? Your loyalty is the trap. Let's look at the numbers. To build a $12 billion profit center, you first have to solve a biological problem. Human beings are evolutionarily wired to feel pain when they lose an asset. Neurologists call it the pain of paying. When you hand over a physical $20 bill, your brain's insula lights up. This is the same area that processes physical pain. Cash is a natural brake system. It is visual, it is tactile, it is finite. The credit card industry's primary innovation was not the line of credit, it was the decoupling of the purchase from the payment. When you swipe, or tap, or use a digital wallet, the insula remains silent. The pain of paying is delayed by 30 days. This isn't an accident, it is behavioral engineering. By removing the sensory feedback of spending, banks effectively cut the brake lines of the consumer mind. The data is cold and undeniable. Consumers spend between 12 and 18% more when using plastic compared to cash. But the banks needed a way to make you love the spend. They needed a way to turn a debt trap into a game. Enter the loyalty program. The points economy is a $15 billion shadow currency. Think about the word points. It is a psychological shield. It replaces the concept of money with the concept of score. Banks tell you that you're earning 2% back. They tell you that your flight to London is free. But there is no such thing as a free flight. Every time you swipe that premium metal card, the merchant is charged an interchange fee. These fees range from 1.5 to 3%. To survive, the merchant raises the price of every item in the store: the milk, the bread, the fuel. This means that every person paying with cash, usually the most economically vulnerable, is subsidizing your free vacation. It is a massive, invisible redistribution of wealth from the poor to the elite. But for the banks, the rewards are a loss leader. They are the cheese in the trap. The goal is not to give you points. The goal is to induce recklessness. Internal bank data shows that rewards card holders carry higher balances and are more likely to incur interest than non-rewards users. They lure you in with a sign-up bonus, and they keep you there with a 24% APR. They are betting that your desire for points will eventually override your fear of debt, and they are winning. Let's talk about the late fees. $12 billion. This is the most efficient revenue stream in the corporate world. It has zero cost of goods sold. It requires zero marketing. It is pure, liquidated profit. The industry argues that these fees are necessary to offset risk. The data tells a different story. In 2021, when the government issued stimulus checks, late fees plummeted. Why? Because people had liquidity. This proves that late fees are not a behavioral incentive, they are a surcharge on poverty. The banks don't target the millionaires with these fees, they target the households living paycheck to paycheck. The deep subprime account pays an average of $138 a year in late fees. For a super prime account, that number is negligible. The business model is simple. Find the person who can least afford to pay and charge them the most for being unable to pay. In the style of a corporate autopsy, we call this extractive monetization. It is the practice of finding a point of failure in a customer's life and turning that failure into a quarterly dividend. But the interest and the fees are half the game. In the 2026 economy, the real value of the swipe is information. Every transaction you make is a data point in a master profile. The bank knows when you're about to lose your job. They know when your marriage is failing. They know you're pregnant before you've told your parents. How? Because your spending patterns are more honest than your words. They sell this data to advertisers. They use it to adjust your credit limit in real time. They use it to nudge you toward higher margin products. Your loyalty card is actually a tracking device. The free flight was never free. You paid for it with your privacy. You paid for it with the metadata of your life. And as we move into the era of AI-driven finance, this harvest is becoming automated. The algorithms can now predict with 90% accuracy which customers will default 6 months before it happens. Do they use this to help the customer? No. They use it to maximize the extraction of fees before the collapse.
We are entering the subscription society. The goal of the modern financial system is to ensure that you never own anything. They want you in a state of perpetual debt service. The credit card is the gateway drug for this transformation. It starts with a loyalty program. It ends with a life where every paycheck is spoken for before it even hits your account. Inflation is currently eroding the real value of your wages, but interest rates are remaining sticky. This creates a margin squeeze for the average family. The gap between what you earn and what you owe is widening, and the banks are filling that gap with more rewards and more offers. They're offering you a life raft made of lead. The loyalty trap is not a glitch in the system. It is the intent of the system. So we return to that 5-gram piece of plastic. It is not a tool of freedom. It is a highly tuned instrument of capture. The $12 billion in late fees is just the tip of the iceberg. Underneath sits $1 trillion in revolving debt, $1 trillion of human potential locked in a cycle of interest and anxiety. The banks have built a world where the points feel real and the debt feels invisible. But in a clinical autopsy, we look at the reality. The reality is that your loyalty is being sold, your behavior is being engineered, and your future is being liquidated one swipe at a time. The only way to break the trap is to see it for what it is. It is not a game, it is a harvest, and it is time to stop being the crop.